Hello everyone, once again, this is Sunil and welcome to Forex with SK. Today we're going into episode 2. So specifically episode 2 of our series, A Practical System for Trading Foreign Exchange, covers a number of different concepts and dives into specific details of the book. How to open an account, which brokers to consider, what role does leverage have, and some indicators. So there's about 3 or 4 of the indicators that I use in all my trading systems. So by itself, episode 2 is packed full of stuff. It can't possibly be described in just one session. So we're probably going to have to split these sessions into 2 or maybe 3. Joining us is the same group of individuals who was there last time. In fact, we have a couple of new additions. So before we move forward, we're going to open up the floor for any questions that remain from the last time's episode. As always, we want to make sure that every participant is comfortable and we move forward at their pace. So with that, I'm going to open it up for any questions from the previous session before we move forward.
Can you just clarify the 2 podcasts that you do usually?
Okay, so first let me describe the 2 series. The first series, A Practical System for Trading Foreign Exchange, is all about giving people a 30,000-foot helicopter view of the book. It paces someone through and they can decide what's in the book. Is there really enough there for me to get interested? So the journey through the book is through podcasts 1 to 20 of the first series, A Practical System for Trading Foreign Exchange, where a number of concepts are clubbed together in no more than a 10-minute podcast, 5 or 10-minute podcast. So there's only limited amount. You just get a flavor for what's there. The second podcast series, Forex with SK, let's just focus on the podcast series and then I'll cover these sessions separately. Forex with SK is a special session for those who actually decide to take the journey. So the Forex with SK podcast is for those people who've already decided, they've joined me on my sessions, they've bought the book, and I'm taking people through some of the principles of the book to describe what I would call as a 27-day trend. That's just, for people who are not yet fully adept to understand what is the bias of the market. Is the market by and large long or short? Just so they're conscious and I give my thinking behind it. So that is an aid or an assistance for those people who have already taken the journey, signed up. Maybe they're in my classes, maybe they're not. That doesn't matter. But they are following some of my principles and they might actually follow their own systems within that trend. So if, for instance, the 27-day trend is down, like it is right now, I'm calling it bearish, they might still decide to take a different strategy described in my book, maybe a 13-hour or maybe a 50-day, whatever. And they might understand that they're trading against the 27-day, and that's fine. But it's just to give them one additional hook. This series, Forex with SK, is a one-on-one session for people who actually decide to go through the journey in detail. This is with me, and this is the structure of my classes. So you'll see that as you go through this, the structure of this series is very much classroom-oriented. Does that answer your question?
Yes, it does. Thank you, Sunil.
All right. You'll notice the title now, I'm calling it Forex with SK. So this is essentially the format of my ongoing classes that will run day to day. Now, before we move ahead, I must point out the legal disclaimer. This series is purely for education purposes, should not be construed as investment advice or financial advice. Trading foreign exchange does involve financial risk, results in significant loss of capital. It may. And you must consult your financial advisor before risking your personal finances in trading Forex. Trading does involve uncertainty, and past performance is no guarantee of future gains. The views here are entirely my personal views and don't consider your personal financial situation. Also, you do need to check, depending on which jurisdiction you are, whether the regulatory restrictions that prevail or that apply to you are applicable, because Forex trading has different laws in different countries. So be aware of those, please, before you undertake this. Now, we did cover last time some elements of the huge nature of the Forex market. And what, the biggest participants in this market are institutions and banks. So these are the big financial institutions, including central banks. They play in the Forex market as well, and the large banks. Now, they get their order flow from large corporates. People like BHP, Rio Tinto got millions and millions of dollars in foreign trade. And that's the reason why US dollar is so dominant, that foreign trade is largely invoiced in US dollars. The operation is nearly 24/7. So early morning, when the Australian dollars start business, that's when trading hours start. And it continues through round the clock. So by the time Australia is closed, Europe is open, and then the US opens. So it's essentially 24/7 through the week. And essentially, the last quotation that comes into the market is on Friday evening, when the last banks in California close for business. Now, all these quotations are fed into an electronic network. So this is very different to the NYSE. There's no bricks and mortars here. It's a fully electronic network. And it's called the Exchange Currency Network. So what happens is all the banks and the institutions are plugged into this network. They feed their bid and offer prices right into it. So any bid and any offer, whatever is there, is available on the market. And anyone else who's in it can hit you for that price and say, here's a bid, I'll take it. So it's perfect. There's so much volume, there's so much liquidity, and you get the best price that's available at that time. Now, Forex brokers also keep their accounts with the ECN. So unlike what you would see in stock trading, brokers tend to keep accounts with the local exchange. Here, they keep it with the ECN. And we as retail traders, when we open our accounts with Forex brokers, they are essentially passing our orders straight through, right into the ECN. So whether it's bid or offer, and we'll get to how that market runs and why the role of brokers is so important. My suggestion to you is pick a regulated broker in your jurisdiction, whether it's the US or it's Dubai or Middle East or wherever, or in Australia, Singapore. There are a lot of advantages in picking a regulated broker. There's transparency, there's regulatory oversight, so they don't play funny with your account. If you have a dispute with your broker, you have someone to go up to, and your capital is protected. That's a very important point. Capital protection essentially means that if your broker goes bust, you still have your money protected. It's available for you. So, and it's happened before. Brokers have gone bust. They've traded clients' monies, and as a result, clients have also lost their money. So if you have a substantial stake, at least by a regulated broker, you have availability of that security. Start small. So start with a demo account. A demo account is just paper money. What that allows you to do is learn the platform, see what the indicators are, try out a few strategies. You've not lost anything, zero. It's just paper money. And you get familiar with a demo account, then scale it up once you get comfortable. Fund it maybe 2,000, then 10,000, and then depending on your appetite, scale it up. Ensure available leverage of at least 30 or 50x. Now, most jurisdictions will give you that, but some brokers may not. So be aware of that. You need at least 30 to 50 times to be able to really make decent money. We've already covered the next parts. Forex is 88% of the total turnover, and the other major currencies are there. But be aware that you get at least 2 time windows in your favor. So typically, each of us is different. Some of us trade mornings, some of us trade evenings. If you can get to see the Forex market at least twice a day, you'll get a better feel. You'll get a sense of its pace, how it moves, ups and downs. It gets you into the habit, the practice of watching these currencies and seeing what's actually governing them. If you do decide to trade other pairs, be aware that the indicator settings in my book are only tested for the Aussie US. So if you take those same settings and apply them elsewhere, they may not work the same. I've already covered. There's 12 hours. And I think the last point is very important. We'll cover it when we talk of spreads. By the time your favored currency pair opens, you need to know, you need to have sufficient trading volume. So for instance, let me take the case of our US participants. If they're onto trading the Aussie US and they're trading late evening their time, they'll find only a few banks in California and the US offering the Aussie US pair. Most of the corporates are closed, they're shut for the weekend. So you may not find enough volume. So be careful of those environments. You do need enough volume. So, and one of the elements which we'll cover as we go forward is you do need to learn the platform. Now, TradingView is another platform popular with a lot of people. If you're already trading and using TradingView for equities, a lot of people do, then that's fine. You can use that for Forex as well. But my classes are run on MT4. I'm not on TradingView. I run it on MT4. So if you're learning and you really don't have a preference, then for joining my classes, I would suggest MT4 because you and I can go on the same journey in that case. Now let's get to the main factors governing the selection of a broker. Okay. Now, regulated brokers, I'll cover just the three jurisdictions we're all in, US, Singapore, and Australia. And I'll cover this one a bit later. Fullerton Markets is a BVI registered broker. We'll cover this last. I have a few here. There'll be more. So Oanda, Forex.com, and IG, where they go under the brand name of TastyFX, and Trading.com. They all offer different platforms. And you'll notice all of them offer up to 50 to 1. So that's comfortable leverage for you. You can start small, as little as $100. You can open an account. It won't get you much, but you can start small. But I would suggest at least $1,000 would get you going and make it reasonably interesting. At least with $1,000 at the end of a week, if you make some money, you can open a bottle of wine. So enjoy the weekend with that. So I think that's a good way to go forward. In Singapore, you have UOB Kay Hian and Saxo. I've had accounts with both. They both offer MT4, and in Singapore, they offer a 50 to 1. The minimum deposit, check with them because they often have their offerings tied up with whether you're a sophisticated investor or not, whether you're doing other investments with them, are you doing equities? So do check with them if you decide to go that way. And as you get to Australia, you'll find regulatory-wise, it's about 30 to 1. You have different sort of opening amounts. I've traded with Pepperstone often. In fact, one of the participants today, I didn't introduce him, I'm sorry. He joins us from Australia. He's one of the first people I trained. And it's because of his suggestions that I've actually started and I wrote the book. He has an account with Pepperstone. So let's get back. Some of the questions that you do need to ask is, do they have demo accounts to start with? Start with that always. MT4, and do ask if they're segregated accounts. So I think all of these do have segregated accounts. Now, this is an important question. Are they market makers? The danger with opening an account with a broker who's a market maker is that they have visibility into where all your stops are. So often some of the sharp practices by brokers are, when the price goes up, let's say you're in a short and you have a price set, you have, let's say, at 65 cents and 25 or whatever, 0.6525. They will suddenly change the market to capture your stops, trigger them, so you hit a loss. And they've got new trades on their book at a very, very attractive price. So mixing your broking account with the market maker, I found, isn't a very good idea. Now, they would argue certainly that, look, they have segregation and the trading rooms are separate. But that's just my personal view. By all means, take your own decisions. Service is very important. You do need to have someone to talk to. So pick someone in your local area that you can talk to because things do go wrong. It's an electronic stage. Everyone tends to put things in front of an AI. It's hard. And some of the brokers do offer some other things like education. They do offer back testing. So if you have a new strategy that you'd like to test on your own, then you can back test it on those. Those are some nice to have features. And then spreads. Do look at the spreads. Log in a couple of times and see if they can offer you fine spreads. That's very important. We'll cover Fullerton markets in a bit more detail. Now, this is a new beast. I thought I'd cover a bit of time. It's a BVI regulated, so obviously the degree of regulatory oversight isn't as strong, but they did give you about 500 to 1 leverage. You can open a simple account with them with a driving license or a passport. It takes just a couple of minutes. And they do offer MT4, but they offer some interesting thing. They belong in the new breed of what's happening with MetaTrader 4 accounts. So let's give you an example. Let's say you are a family unit, father and son, father and daughter, whatever, mom and son. And you say, well, I don't have the appetite for this. Son, why don't you trade my account instead? Now, so you have two options, right? You can give them your password and they can just use your password and trade your account. In which case they have the added burden of trading not only their own account, but your account as well. And if it gets to, let's say, 4 people in the family, it's painful. So CopyPip is a service where one person's trade is automatically copied into another person's account, just in a different ratio. It's an automatic copy, which means if you've done, let's say a $10,000 trade, it can replicate itself into another's account at 15,000 or 20 or 100,000, your choice. It's entirely your own decision how you choose to replicate it. You're sailing close to the wind because this can extend beyond family to a wider group of people. And you're running against the wind because you could be construed as being an asset manager. And the regulators will come down heavy on you unless you have the license to be a funds manager and you have the authority to trade third-party monies. So, if it's just a couple of, people within the family, they might turn a blind eye and say, well, it doesn't really impact the population at large. But if you start to operate it as a business, they will shut you down. It's against the regulations unless you have a license. So it's an interesting thing. I thought I'd leave it. CopyPip isn't the only program. There are some others. I've used them in the past. There's a British company called socialtradertools.com. So let's take another example, right? Let's say you open a large account in the US. I'm just taking a few examples. So you open a large account in the US and you're secure because your money is segregated, you have regulatory oversight, and you have a family member sitting somewhere in Australia. Social Trader Tools allows this person, let's say if you had a family member in Australia that you're lying to trade your account, they can log on to Social Trader Tools, plug in their account, plug in your account and password. You will need that. And then Social Trader Tools replicates every account in this account here, every trade from here into an account in the US. Again, with a different proportion, with a different leverage, whatever it is, that's up to you. The security in that case is at least the custody and control of your account is with you, and they remain separated. So the authority for this person to trade your account is only restricted to trades. They can't use your password to withdraw funds or deposit more funds. You have complete visibility on your account. You know which trades are being taken. You know on a weekly basis how much money is being made, how much money is being lost. And you can just change the password anytime and exclude them from your account. So it's an interesting way of giving security to third party. Let's get to the actual mechanics of making money on Forex. So here's a simple case where let's take a simple $10,000 account with a 50x leverage as an example. Now let's describe the quote. You'll notice, the Aussie US, maybe let's take a quote of 6425. So the way the quote works is, if you decided to buy Aussie, how many US dollars would it cost you? So one Aussie would be 64 cents in US dollars. That's how it goes. It's a bit like it's easy to think of an analogy. When, let's say, you buy BHP, it's a big stock trading in Australia. What's not quoted is the denominator. So when BHP says, someone in Australia says, well, BHP is $50. What they're really saying is one BHP share is worth 50 Australian dollars. So the denominator, even though it's not articulated, is just there. It's understood. It's Aussie dollars. If you get a quote in the US, you get a price for Microsoft. What's not quoted is that the denominator is US dollars. So view Forex exactly like that. Aussie US only means it's a price of the Aussie, just like you would Microsoft or whatever, and it's quoted in US dollars. You need to be aware of this convention because you could be trading this in Australia, you could be trading it in the US or Singapore. So the definition of this quote is, how many Aussies are you buying or selling, and how many US dollars would you have to pay? So let's take an example, $10,000. Let's say you leverage it only once. You buy $10,000, so that's Aussie, right? And the rate was 6,425. So what it ends up doing is it's costing you $6,425. If you then sell it, let's say you make 50 pips, the price moves up, it went in your favor. Your revenue when you sell it would be right there. You made 50 pips, right? And your margin is, let's say, 200. Why? Because it's a 50x leverage. So whatever your position, they will divide it by 50 and block that margin in your account, right? So here in this case, it's a $10,000 account. They'll block 1/50th of it. So 200 of your account will be blocked as margin. The balance is free. You can trade additional positions for that, and you'd make 50. So I have a standard rule of thumb. One pip is $1 on a $10,000 trade. That's the way I remember it, but you can do your own math. Now, that's only 0.5% for the day. Let's say you decide to leverage this 10x. So in that case, you're multiplying everything 10 times. So your 6,004 becomes 64,000. Your revenue is higher and your margin also increases. So notice now, out of your $10,000 account, you've blocked 20% of that account away. It's not available for you if you want to take additional positions. In that case, your profit also goes up 10 times. And so this one simple trade ended up making you 5% for the day. Right? Now, that actually explains why Forex can be so profitable. Even though you have 30x available, by using just a 10x on a single trade, you can actually make that much money. So when I quoted you originally 1% per week, 1 to 2% per week, it's not outside the realm of possibility. In fact, a lot more is possible. So if you leverage this 30x, now you're running close, very, very close to the wind. You would make 1,500. That's a 15% profit on your account. Now, actually speaking, this profit is a lot more in Aussie dollar terms. So if I had an Aussie dollar account, $1,500 times, when you convert it at Aussie dollars, it's actually a much higher return on my account in Aussie dollar terms. But I've assumed just 1:1, just for simplicity, because 1,500 is actually more like 2,200 Aussie or 2,000 Aussie, which is a far greater return. That's almost a 20% return on my Aussie dollar account. But we'll avoid that kind of fine maths. We'll keep it 1:1 for simplicity. And as a general guide, we're never going to exceed 20 to 30 times leverage. Okay?
Question.
Yeah.
I did not understand the margin, $200 or 2,000, 6,000. Can you explain it? How the margin is calculated? What does it mean?
So in this account, your leverage is 50 times, right? So if you had a $10,000 trade, the broker would block 1/50th of that as margin in case the account suddenly went sideways. This is a broker protecting himself. If he had to exit you and you had no other money in the account, then 200 is still available for the broker to close your money and for him not to be out of pocket. So he's blocking your availability of $200 because of this trade. Okay, let me explain in a different way. If you had an open position, $10,000 right here, and you said, right, I want to withdraw my account. I want to close it. The broker would say, hang on, you have an open position, 200 is blocked towards it. I'm only going to allow you 9,800 to be withdrawn because 200 is my safety margin for fluctuations in case your $10,000 position goes against you. Right?
Got it. Yeah.
Yeah.
So I understand. It's not money gone out of the pocket. It's just money blocked that you can't use for further trading.
Absolutely.
Okay.
All right. Now let's move on to another piece, which is risk management. I'm conscious of the time; we're running pretty short, so I don't know if we'll be able to run the bonus session today. But let's see. Risk management dashboard is your system. What are your trends? How they're going? You decide what you put in your risk management dashboard. It's very important. It's critical. So if you decide to skip this, I guarantee you will lose money. Risk management dashboard is one of the most important. It keeps all the key trends that you're monitoring. It keeps your current equity. It keeps a track of all your open positions. I use a simple spreadsheet to do it. It's very easy these days. It's an online spreadsheet which keeps an update of all your positions. It's an essential skill to keep this up to date on a daily basis. We covered the second rule, risk maximum 2% of your trade, and I'll show you a bit later how position sizing is worked out. Do keep a detailed trading diary, what mistakes you made, because your personality is what's going to determine how successful you are. And do review your performance stats every week. Now, coming to performance stats, that's item 5. Let's actually go through and break it down as an example. You'll hear these comments within the trading community. So let's take the top line, right? Your profit, if any, that you make is a function of the number of wins that you had and the average number of wins. So if you made a total profit of whatever, X divided by 5 trades. So you divide your profit by your 5 trades and that's your average win. Right? So your total profit is a function of your average win per trade times the number of wins. Your loss is the same thing, average loss times the number of losses. And the only way you make money is if your numerator is greater than your denominator. Now, let's flip that equation around so that the left side moves together. So your average win to average loss is something that's called as a win-loss ratio. Average win to average loss. Now, it's obvious, right? If you're trading, your win-loss ratio has to be more than 1. You need, when you win, you need to be winning more than when you lose. If you find in your trading stats that that's not true, something's wrong with your trading system. Correspondingly, the right side of the equation is also important. How many wins to how many losses? If you've done five trades and 4 of them were losses, that's not a good trading system. So both sides of the equation need to be good. Your win-loss ratio must be more than 1, and your hit rate must be positive. You must be having more wins than losses. So if when you multiply those two, you get something which is called a positive expectancy. Now, we'll cover this in detail. The Fibonacci series is actually a very old series, I think 2000 BCs. In Hindu culture, Sanskrit, a mathematician discovered it. Later on, Fibonacci, the French guy, the Italian guy, he just popularized it in the Western world. But it's a simple series, and you'll see the spiral, and in that, it'll come up. So if you take 1, 2, 3, and you start to go, the first number is just the sum of the first 2. That gives you a 2. 2 plus 1 gives you 3, 3 plus 2 gives you 5, 5 plus 3 gives you 8, and so on and so forth. So if you add the next two numbers, you get 13, and then 13 and 8 gives you 21. It's an interesting series because when you take the ratio of any two numbers, one divided by the other, you notice the ratio is almost the same, 0.61 or roughly 2/3. So this principle is used sometimes to measure retracement levels. So for instance, imagine you've thrown a ball in the air. Well, that's not a good, okay, let's say you bounced a ball on the floor. The degree of bounce may not be 100%, definitely not, but it might bounce 80%, it may bounce 60%, it may bounce 50%, depending on the momentum of two conflicting forces. So the Fibonacci ratio is used often by traders. It's a number that's prevalent across nature. You'll find it everywhere. I won't spend too much time on this because there's enough on the internet on Fibonacci. Please do look it up. The other number series that I look at very actively is the prime number series. You'll notice all the prime numbers are odd numbers, and we'll come to this when we talk about trends. So prime number series are very important in my trading system. I would, for instance, talk about a 13-hour trend, never a 12-hour trend. I would talk about a 17-hour trend. And so when you look at the core of these, usually in your trading system, you at the smallest number you would trade is either a 1, 2, or a 3-day trend. It's a daily trend. Yeah. Now, when you find a correlation between the two, so for instance, 1, 3, 5, and 13 are also Fibonacci numbers, you might find in my system that these numbers tend to replicate. They tend to recur often in my trading system. So just get familiar with those. And in my system and methodology, those 4 numbers have a very special significance. Now, I don't know why. So let's take 27. I'll give you an example. When I talk about a one-day trend, I'm talking usually not about a 24-hour day, but about a 27-hour day. And when I'm talking about a 2-day trend, I'm doubling it and I'm calling it a 54-hour trend, not a 50-day, not a 50-hour, not a 48 hours. It's 54 hours. It's just a unique way for me to run these numbers. And one of the reasons why it works is take 9 days, for instance. Okay. So when you take most financial markets, when you talk about W.D. Gann, he was able to split a big market or long-term trends into eighths and quarters. Not more than that. Generally, eighths and quarters work. So notice if you take a 24-hour day and you take 9 days, you will get 216 working hours in 9 days. 9 times 24 gives you 216. And if you divide that by 8, you get 27. And so my systems have this kind of correlation. This 1 day is 1/8 of my 9 day. And you'll come to this later. When you take 54, for instance, 54 on an H4 chart is exactly 9 days because 6 bars in an H4 is 1 day. And so 54 is 9 days. And so look at the correlation. 216 on an H1 chart is exactly the same as 54 on an H4 chart. My apologies. This math can bend your mind a little bit. You will get used to it, believe me. Just be aware of what it is. You can come back to this podcast later and look at these numbers again and get them settled. But this is how these numbers break out. So what I was just describing to you is on a long-term basis, most people talk about trading a 200-day moving average annually. I don't talk about 200 days. I tend to talk about 216 days. And it's the same relationship. When I split this into 8, I get 27 days, which is roughly the number of working days in a month. So this is about 1/8 of that, or quarters of 54 days. So that relationship holds true even through when you look at 9-day trends. Now, here is where it gets interesting. if you split a 216-day year into eights, you get 27 days. You add a ninth segment, which means if you add another 27, you get 243. Now, we'll cover this later when we get to breakouts, but 241 is a prime number. It gives you a unique spot where the annual trend reverses. It breaks the highest and the lowest price for the entire year. And it tends to be a unique number that holds true for a very, very long time. Once again, these numbers are going to be available on YouTube. So do look at it, get familiar with them. But that's how a lot of my trading systems percolate. These equations go back and forth. Once you get familiar with them and you start trading on MetaTrader 4, they'll become second nature, but it takes a little time to get used to. I can do the math simply in my head. I know exactly, but it needs a bit of practice. So let's move forward. I think it's good enough for questions and answers, and we can move, if time permits, we can move to the next segment if you're willing to move ahead. But let's focus on any remaining questions so far. This is all I'm planning to cover so far in the second episode of the podcast. There's a lot more in the second podcast, which covers some indicators, etc. But those make sense only after you've opened an account. So I would suggest for the next series, do run through brokers, open an account. I suggest you open a demo account, because unless you have a real live MetaTrader 4 account in front of you, we really can't move forward with these classes to show you how these indicators are set. You can only get so far by watching. Ultimately, you have to get into the driver's seat and start driving. All right, great. Well, thanks very much for joining, and we'll see you next week.
Thank you so much, Sunil. We
No,
really
not at all.
appreciate your
Great.
time.
Thanks, you could join.
Thank you.
Thank you.
All right, talk later. Bye.
Bye.